Uber Technologies just produced its first positive cash flow, positive operating earnings results in 2023. The stock still trades at a massive premium. It's still expected to grow heavily. Let's figure out, if you bought the stock today, held it for 10 years, how much money you can make. You ready? Let's get to work. Welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you so much for watching the channel, all the comments and subscribers. I greatly appreciate it. Hit the subscribe button, hit the like if you like the material. I'm traveling this week, so I'm on doing kind of a remote video from a hotel room, but let's see how this works. We might do it in the future. Let's take a look at Uber Technologies. As I said at the outset, this channel is going to dive into the cash flow of Uber and figure out how much actual hard money, how much jack they make, and is it worth buying the stock today and holding it for 10 years. Now on this channel, as you know, for the regular viewers, we look for hard cash flow. We want businesses that are producing a lot of cash, are reinvesting that cash into growing the business, paying down debt, buying back shares, maybe paying a dividend, but it's not a requirement for us. That's what we want. We try to sift through the accounting data, kind of the mumbo jumbo that management gives you, to understand what is the business truly doing, and if you bought it today, would you grow and would you make some money? And we look at stocks with 5 key attributes. Number 1, we want a stock that is growing top line revenue. Number 2, we want a stock that's growing earnings. Number 3, we want strong free cash flow. Number 4, we want low debt. And number 5, we want a well-priced stock, meaning a stock that's reasonably priced, not too cheap. We're not bottom fishing here. We're not picking cigar butts off the floor, but we don't want to pay too much for it. The biggest thing you do is buy a great company at a reasonable price, and that's what we're searching for. We don't always get it, but we use the 5 key attributes as a grounding for us to do further due diligence. So let's dive into Uber Technologies. So here we are with Uber Technologies. I'm in the cash flow club right now. We're taking a look at the notes that David's written up on the stock. We're going to get to the one-pager in a little bit. The stock was founded in 2009 on its IPO in 2019. Uber's reported adjusted 23 EBITDA of $4.1 billion and $3.6 billion of cash flow, including almost $2 billion in stock-based buybacks. That's a massive amount of stock that they're giving to their employees, and something they need to be able to deliver enough value so that that's not dilutive. Here's they're breaking down the segments. Mobile, delivery, freight, and so forth. Gross bookings is interesting. So these companies that are startups or have e-commerce platforms, sometimes they won't talk about revenue right away. They'll talk about bookings, or they'll talk about TAM, total addressable market. What you want is them to talk about cash flow primarily. If you don't have cash flow, they talk about revenue. If they don't have revenue, they talk about TAM, or in this case, gross bookings. $38 billion is a huge number, but then to only make adjusted EBITDA of $1 billion on that's super thin margins. If you're going off the gross bookings, I believe their revenue is actually a different number than that. We'll get to that in a second. So here we have the first page, one of the pages in their investor presentation, and they've got 19 million members, it looks like, and total gross booking coverage of 30%. Like these are great just metrics for the business, but it's not revenue. It's certainly not cash flow. In my experience, businesses that have poor cash flow generally will talk about non-cash flow items, bookings, total addressable market, number of customers, the social impact they're making. But if they had cash flow, they would talk about cash flow. This is, industry scaling, making the journey better. Okay, fine. I'm not going to talk about every one of these slides, but I do want to kind of go through it a little bit. Delivery keeps delivering. Nice. And they finally turned profit. I think there's a new CEO in there to actually make some profit. They made $1.5 billion of adjusted EBITDA here, if you define that as profit, in 2023. So it's finally kind of turned the corner on the delivery section for them. Mobility. Here we go. Here's business overall. So significant growth and momentum since the IPO. So they're pointing to bookings, and they're saying, hey, bookings are moving up 2.8 times, or $88 billion from 2018 to 2023. Great growth. They were vastly negative from most of this. terms of the total cumulative EBITDA that they have lost over that period of time, it's been astronomical. They finally turned a profit in 2023, total adjusted EBITDA of $4.1 billion. Here's kind of a know-nothing chart. Key growth drivers, customers, engagement, spend equals bookings. That's nice to know, thank you. Operating profitability at a GAAP level, this is interesting, achieved Q2 2023. So we want this light blue number, the GAAP operating income. So they lost in Q1 of 2022, lost in Q2, lost in Q3, lost in Q4, lost in Q1 of 2023. Then profitable, good job guys, they made a profit. And they've been profitable each of the last 3 quarters on a GAAP basis. And that's moving higher, which is great to see. Still really low margins, 2-3%, but growing. Good job. Here we go, free cash flow. Free cash flow has reached an inflection point. Let's hope so. Free cash flow is in black here. So free cash flow from 18 to 2020, they burned $10 billion. Wow, that's a lot of money. In 21 to 23, they made $3 billion. And they're saying by 24 to 26, over 90% growth. Interesting. So still no real number here, but they're saying it's going to be bigger. Here's their adjusted EBITDA reconciliation. So they've got here net income that is GAAP. Net income was $1.9 billion on the net income. Adjusted EBITDA, $4 billion. And let's see what some of the things they put in here. Goodwill, restructuring charges, fine. Here you go, stock-based comp right there. I can't highlight this, but stock-based comp, $1.9 billion that they added back in the adjusted EBITDA. That is not correct. This adjusted EBITDA number is garbage. You should not be adding back stock-based comp. It's a part of payroll. If employees don't get it, they're going to want the cash payment. So their adjusted EBITDA is a lot less than what I would consider would be a normal EBITDA number. But they're still profitable. All right, let's take a look at their revenue. Let's see what we have here. Let's take a look at, here, year-end 2023. That's cash flow, year-end revenue. So over here, 2023 revenue, $37 billion. That's a lot less than the $80 billion of bookings that we were seeing earlier. So bookings is not revenue. Let's start at the black and white. Let's figure out how much money they make. They start with revenue, $37 billion. That's how much money they made. And it was up year over year. That looks to be about $6 billion, about 20% revenue growth year over year, which is nice. Cost of revenue, there's COGS, $22 billion. That's a lot. Operating support, sales and marketing, research, general admin. General admin is basically the corporate staff that it takes to run the business, which is pretty low, actually. I like that. That's a reasonable number, in my opinion. Depreciation, total costs, $36 billion on revenue of $37 billion. We are talking razor thin margins here. They have debt expense, which is actually positive. That means there's probably positive cash in the balance with limited debt. So this is a credit to the account. They're actually getting income here. Oh no, I misread that. Other income, that's other income. I thought you was adding the income here. So that's still an expense for interest. Interest is cost. And they made income before taxes of $2.3 billion on $37 billion of operating income. So pretty thin, but still positive to their credit. Here's their stock-based comp, which is really huge. I mean, $2 billion of stock-based comp. Let's just go back to their total revenue, about $40 billion. So you're talking what, 5% or so of that is stock-based comp. That's a lot of revenue to give up to the employees every year, especially when you're barely profitable. but they made $3.5 billion of actual operating cash flow. Now we'll adjust that down at the Cash Flow Club. We will take that down by the stock-based comp, just to make sure we burden the business a little bit more, to be a little more honest about how much they're making. So we'll take 3.585 billion and we'll subtract the 1.935 of stock-based comp as an adjusted free cash flow from operations number. CapEx, very light here. It's a light CapEx business. $223 million is nothing. And then on the financing section, they've got a loan here that they're kind of recycling. They're borrowing and paying down loans. That's fine. Nothing much to say here. It doesn't look like they bought any stock. Here you go. Proceeds from the issuance of common stock under the employee stock plan, $130 million. Proceeds from the sale or issuance of subsidiary stock units. So they didn't buy any stock back. The stock-based comp that they expensed of $2.1 billion, right? Of 1.9 billion that they were adding back to adjusted EBITDA. They don't actually buy that stock back in the stock market. They just let it dilute everybody. That's a real problem, and that's a true non-add back that they are adding back and pretending the cost doesn't exist. They're lying to you. In my opinion, that's wrong and deceitful, because they're not actually going here and buying the stock back in the open market to cancel out that dilution. They're allowing the dilution to happen, but then over here on the income side saying, hey, don't worry about it because I'm adding it back. It's a non-cash cost. It's not. It's dilutive to you. You need to be aware of that. Assets, they ended the year with, it looks like $5.3 billion, $5.4 billion of cash, which is strong. 11 of AR, of current assets. Let's see, equity, not much goodwill, so that's a pretty decent balance sheet. Liability, short-term receivables, fine. Long-term insurance reserve, that's fine. Long-term debt of $9 billion, so they do have some debt, which is interesting. Now their EBITDA of $4 billion is pretty reasonable, but most of that 4 was stock-based comp, so the debt level is not great. Passable, but not great. Okay, that's the income statement and balance sheet cash flow. Let's dive down a little bit more and start building a forecast for this business. You can see the stock kind of has moved up and down as the pandemic hit and so forth. It's kind of back up now quite a lot. Let's take a look at some charts here to see what really works. Monthly active platform customers and a % growth. Customers are growing nicely. It is becoming a nice service. Growth rates are solid, members grow, so if they can squeeze dollars out of those people, over time they can grow their margin, and over time that margin should unlock more free cash flow. Total tips is interesting. Total tips and total tip percentage. Wow, 24% of the people tip? That's impressive. So here's the adjusted free cash flow of the business over time. You can see it's lost money, cash flow, for its entire operating history, with the exception of the last 2 years. Really, it's kind of turned positive after they got a new CEO in there. Okay, here's the good one. This is enterprise value against EBITDA number. So they're trading roughly at 40 times forward EBITDA currently, which is a pricey company. Here's the cash flow one pager. So this is what I wanted to get into. Let's walk through this quickly to understand kind of what this business is actually producing over time. We'll take revenue. Looks like revenue, strong growth, 62% annual growth rate over the last decade, which is absolutely impressive. Congratulations for that amazing growth. After that, profitability, we use EBITDA And we're not going to allow them to add back stock-based compensation. You can see EBITDA for us that we have is $1.9 billion, much less than the 4 that they were talking about, because we're not adding back the stock-based comp. That's a very, very thin margin, and they just turned profitable, in our opinion, this past year, not prior to that, because of stock-based cost adjustments. They have $11 billion of debt, which is a leverage ratio of 6 times. So it's very highly levered with a business with very thin margins. They are dependent on issuing equity to keep this thing running. And you could probably see that here in the shares outstanding. Absolute massive dilution over the last 8 years or so, from 412 million shares to 2 billion shares outstanding. And those shares outstanding continue to grow as they continue to dilute to pay their employees, not buying back those stocks. Adjusted free cash flow from operation, the true jack of a business. How much cash and money, how much hard jack do they make actually running their business? And in our opinion, by not adding back stock-based compensation, they make $1.6 billion a year in cash flow after almost a decade of losing money. So that's very concerning. I would have liked them to have been making money this entire time. It's very hard to judge a business on 1 year of positive cash flow. But nevertheless, let's make a forecast. So if we say that they're going to make $4 billion next year of EBITDA, which is a lot, the big jump, and then that $4 billion is going to grow to $12 billion in the next decade. That's a 3 times, almost 6 times growth from last year's EBITDA number. Massive growth. And we're going to assign a 20 times market multiple, enterprise value EBITDA to that. That gives me a stock-based price estimate out 10 years, kind of a guess at a price of $114 a share. I could do the same thing with free cash flow. Now remember, the stock made 66 cents of free cash flow last year. It was the first positive year they've ever made positive cash flow. They're still diluting you, but it was positive. Well, if I grow that over time, very, very healthy, aggressive number, so I get to $4 to almost $5 of free cash flow from 66 cents, and I apply a healthy yield to that of 4.5%, I get a stock price of $105. Okay, so average the two and say I'm about 110 out 10 years. I think it's going to be at. Okay, what's the stock today? I can buy all the stock I want for $78 right now. So I'm going to get a little bit of a gain between $78 and 110, a little bit. I'm going to get some free cash flow that's small. It's going to grow over time from $1.64 to $4.74. Now, when I put that in an IRR calculation, that gives me an 8% IRR, which is below what we would expect from the S&P 500 over a decade, and not going to meet the standard for us to say, hey, this is really an outperforming stock. Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing. Number 2, EBITDA. Yeah, EBITDA is growing. I'll give that to him. Strong free cash flow, no. I don't think that meets the mark. The margins are weak, they just turned profitable, and they're adding back stock-based comp, pretending like that's actual cash flow, and I don't like that. Number 2, low debt, no. They need to grow earnings more to grow into the debt they have. And well-priced, no, I don't think that's well-priced either, because it's not giving me a 10% or higher IRR as an estimate. So that is Uber Technologies. A quick breakdown on the stock. I'd like to see them lower that debt level, squeeze more free cash flow, and continue growing the top line. Maybe if there's a pullback, I'd consider buying it. Probably come into a better value, about $70 or maybe $60 a share. Start becoming interest. I hope you liked the review. I'm on location traveling. I thought I'd just crank out a quick video. But let me a comment. Let me know what you'd like to see for the next videos. Put a comment down below, helps the algorithm, and share on social media. Thank you so much for watching Rational Investing. My name is Cameron Stewart, CFA. Have a good night.